Earnings season is back, and you know what that means. Massive swings up or down in our holdings. Today has already been wild, especially in the semiconductor industry, as we get a peek of what's to come when ASML released an ominous cut to its forecast. That sent shockwaves through chip stocks, with ASML falling 16%, Applied Materials down 10.7%, Nvidia down 4.7%, and Texas Instruments down 4.2%, just to name a few. It was an ugly day on the street as the S&P fell 0.75%, and the Nasdaq was down 1%. This video is about UnitedHealth Group, however, and analysis into their, in my opinion, strong earnings. Investors had other ideas though, as capital flight out of UNH sent the health insurance giant tumbling a gut-wrenching 8.1%. Welcome to the Quality Investor. Earnings season is always a favorite of mine. We get our quarterly updates on all the businesses we own, and sometimes huge gains. But other times, earnings disappoint, and that sends our holdings into our downward spiral. And in those troubling times, we start to question everything about the business that we own. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. But that is a negative mindset. Remember, when we bought into these businesses, we bought with the conviction that over our long time horizon, the businesses will be significantly more valuable than they are when we bought them. And we told ourselves we would weather Mr. Market's depressive episodes because we know the fundamentals and the core reason we bought remain intact. Most importantly, when our holdings get ravaged after earnings, we savvy investors might just lean back and say to ourselves, is now a good time to buy a little bit more? That opportunistic mindset is what will enable us to grow our wealth over the long term. When we recognize opportunities, we must pounce, because sometimes it doesn't take long for the market to correct itself. And that is the crux of today's video. UnitedHealth Group was in the doghouse until about mid-June. UNH spent the first half of 2024 weathering negative event after negative event and was beat down to a woeful $436 per share. DOJ investigations, cyber attacks, Medicare debacles, and more was taking its toll. But those of us that paid close attention realized that none of these events were fundamentally altering the core operations of UnitedHealth. Sure, the market was panicked, but to me, it was a good time to take advantage of the meltdown. I steadily added a few grand to my position, with my last purchase occurring July 3rd at $488. Since then, the stock took off, reaching as high as $608. It felt like all the bad news was finally in the rear view mirror. But there is no resting in this game, as there is always a new earnings right around the corner. And today, UNH was up to bat. Overall, I thought it was a solid quarter for them. They beat estimates on revenue and earnings and delivered strong cash flow growth. But investors had other ideas and punished UNH today to the tune of an 8% drop. So we are going to unpack their earnings release, look at why they fell, and then assess if today's 8% decline puts UNH back into the buy category. UnitedHealth closed the day at $556.29. You can see it was trending upwards nicely over the last few days before this sharp drop-off this morning after earnings were released. They recovered a little bit, but then just staggered downwards the rest of the day. So what was so terrible about the earnings? You can see they had revenues over $100 billion just in this quarter alone. An $8.5 billion increase year over year, and the consumers served by healthcare's commercial domestic offerings, it grew 2.4 million year to date. We can see year to date, UNH has nearly $300 billion in total revenues. That's an 8% year-over-year increase in the same period last year at $277 billion. However, the earnings from operations, they're actually flat year-over-year, $24.5 billion versus $24.6 billion last year. And net income, it looks even worse. Net earnings were at $9.4 billion versus $17.4 billion last year. And we see the big culprit here is this loss on sale of subsidiary and subsidiaries held for sale. Now, I've talked about this before in previous videos. UnitedHealth divested its South American business, primarily located in Brazil, and that resulted in a massive one-time hit to their earnings. Now, going forward, that should make them more profitable, but we're not going to see that in 2024. The operating costs also absorbed a lot of the cybersecurity attacks that happened earlier in the year. I also talked about those in a previous video. So we're seeing a lot of one-time events occur for UnitedHealth in 2024 that should get flushed out once we roll over to the new year in 2025. And we should start to see their earnings normalize a little bit back to where they were prior to this year. One green shoot, however, we can see that this quarter they had earnings per share here of $6.51. Year over year, that is up from $6.24. So it's only a 4% increase. However, you can see them starting to return back to their normal growth operations. So what has spooked Wall Street so much with this earnings report? Well, for one, we can see that their total operating costs, $274.9 billion. Year to date, that's an 8% year over year increase, right in line with the same increase from revenue. So they're not expanding their margin. If you look a little bit deeper, you can see the operating costs, they're actually down from the previous year at $40.5 billion versus $41.2 billion. So that means the real culprit here is this: medical costs. $197.15 billion in medical costs. Compare that to last year's $179.6 billion. And here we see why Wall Street is not happy. That's a 9.7% increase, a faster increase than revenue. And anytime we see margin contraction like that, Wall Street's not going to be thrilled about that. UnitedHealth lays it out right here. The medical care ratio, or the percentage of insurance premiums paid out as medical costs, was 85.2% compared with 82.3% last year. That's 290 basis points higher. That's a large increase. And they noted that the factors contributing to the increase were previously noted CMS Medicare funding reductions, medical reserve development effects, and business and member mix. But that's not the only reason Wall Street is upset. Aside from margin contraction, Wall Street hates it when businesses lower their guidance. And that's exactly what UnitedHealth did. It says the company's full year 2024 net earnings outlook is now $15.50 to $15.75 per share. That was lowered from $15.95 to $16.40 per share last quarter. UNH even lowered the adjusted net earnings outlook, $27.50 per share to $27.75 per share, which is down, on the high end at least, from $28 per share. They try to sugarcoat it a little bit, saying they're within the $27.50 to $28 range, but let's be honest, they lowered guidance. And not only that, it says they absorbed an estimated 75 cents per share of business disruption impacts for the affected Change Healthcare services. That was part of the cyber attack. Originally, they stated it was probably going to be about 60 to 70 cents per share of an impact. So they had more of an impact than what they thought. So all of these factors combined sent the stock down nearly 10% today. But despite the bad news, I do want to share a little bit of good news, and that's the commercial domestic insurance rules. They had 29.7 million people insured on the commercial domestic side of it, compared to the beginning of the year where they had 27.3 million. So that is a nice increase of 2.4 million throughout the year. That's good because more people into the system means more premiums getting paid to UNH. That's going to increase the revenues. Now it's their job to lower those costs a little bit, get all this business disruption behind us, and get back to steady, slow but steady margin expansion and cash flow growth. Speaking of which, we did see some nice cash flow growth. So the cash flows from operations down quite a bit from last year at this time to 21.8 million versus, so cash flows from operations down quite a bit to 21.8 billion from the same period last year, 34.2 billion, due in large part to the really bad earnings they've been having this year due to those events that we've already discussed. But capital spending has remained relatively in line. $2.5 billion in capital purchases this year, as opposed to $2.4 billion last year. Now, while their cash flow for the year to date is still way behind what last year's was year to date, their free cash flow for this quarter was $12.9 billion. That is up from $6 billion a year ago in the same quarter. That's over 100% increase. So they're getting back to solid cash flow growth after getting a bit of a hit in both Q1 and Q2 due to these one-time events. So they're getting back on track. We should expect to see a lot better growth in 2025. So UNH had a bad day in the markets, but are they worth buying right now? Let's take a look at their valuation. So after updating the numbers for this quarter, we can see that they're actually right on track for revenue, pretty much right in line with what I estimated for their year one at $396 billion in revenue. But when it comes to the operating profit, that's where they start to fall behind a bit. We're off our year one tracking by about 4%, and that's due to lower than expected margins. And of course, the huge miss, 32% behind what our net income estimate was, that's due to the one-time events that obviously at the beginning of the year we did not foresee. It's going to be the same story for the diluted earnings per share, and then of course, free cash flow is ultimately going to be affected by the much lower net earnings. But as we can see, the free cash flow, what we love to see as investors, it's steadily getting back to normal. $401 million in Q1, $5.8 billion in Q2, and now $12.9 billion in Q3. And you can see they're getting back to where their normal levels of free cash flow are in a normal year. Once the results were in for Q3, I did have to revise my estimates a little bit. I lowered my operating margin from 8% down to 7.25% to become more in line with what we expect to see over the next year. Interest expense margin here, it's at 14%. I raised that from about 12% to be more reflective of what the actual numbers have been showing us lately. Income tax percent's right in line. I did increase the free cash flow conversion number a little bit due to the large pop that we saw in free cash flow in Q3. It appears that they're going to finish Q4 strong. And I think even though I increased it from about 80 cents for free cash flow conversion to 90 cents, it still reflects a much lower number in year one. And it looks like they're only repurchasing about 1% of their shares as opposed to about the 1.25% I had prior. So ultimately my estimates through year 10 here, on a base case, I have the operating margin growing to about 9%, net income margin growing to about 6%, and the free cash flow margin growing to about 6.6%. So keep in mind when you see the discounted cash flow numbers here in a second. Remember, the trailing 12 numbers are a little bit depressed from their normal levels due to this one-off events that we've been having. And my year one estimate reflects about a typical loss in Q4 that UNH has in their free cash flow of about $1 billion in this year. If they really hit their stride over the next 10 years or so, we could see a free cash flow margin of about 7% here on nearly 8% total revenue growth. It seems 8% has been what they've been doing revenue growth wise over the last few years. UnitedHealth closed the day at $556.29. Their current PE sits at about 36.2, far above their 5 and 10-year averages. 23.5 is their 5-year average and 21.8 is their 10-year average. But their forward PE is at a more respectable 25. So based on what I just showed you, the discounted cash flow for the bear case comes to $477.21, $607.89 for the base case, and $777.19 for the bull case. Their dividend discount model here, $544.33 for the bear, $640.44 for the base, and $775.09 for the bull case. Their exit multiple comes in $290.12. The comps I'm using for the exit multiple are Elevance Health, Cigna Group, Centene, and Humana, all of which are trading very cheaply compared to UnitedHealth right now. They have an average PE ratio of about 18, half of what UnitedHealth is trading at. So you can see the upside and downside here. Almost 20% downside if everything goes wrong for UnitedHealth and it's a bear case. 3% downside in the base case, but nice, respectable 17% upside on the bull case, without any margin of safety. Right now, they have a buy price at $543.82. So even right now, their share price didn't come down below what I think the fair value of $543 is right now. At a 10% margin of safety, it's a buy price of $489.44, or a forward PE of 22, which would sit right in between their 5 and 10-year average. So if I want to buy UnitedHealth again, I'm going to be waiting until it gets back under $490 at the very least. So they have to have some more very negative news events come out that send that share price spiraling back down. Maybe Humana has terrible earnings and drags them down along with them for me to buy back in. I still think they're trading very highly, but I'm not going to be selling. Definitely a hold for me, as I want to hold them for the long term to reap the gains I believe that they're going to have. All in all, UnitedHealth had a solid quarter, not a great quarter, but not bad quarter. And of course, Wall Street hit them for the margin contraction and cutting guidance. But I still think they're trading a little bit above their fair price. They're certainly not at a reasonable price to buy right now. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.